Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about home sales, home prices, jobs data, and mortgage rates. Logan, welcome back to the podcast.
Happy Halloween, everyone. And just before we engage anything, somebody well-known said that the U.S. went into a recession in October of 2023.
Wait, who are we talking about? You have to say it.
And no. There are a lot of people who listen to us know who I'm talking about, and it's October 31st, 2023 or 2024. It never happened. Always be careful of who you listen to, especially if they're generally doom porn bearish all the time. It's just not all working up there, guys. There's a point in history where you just have to look at yourself and go, why am I listening to this person? Okay, so
anybody who's a perma anything, because the data doesn't justify a perma anything. Like you are so pro-America, but you are not a perma bull because you just follow the data.
Yes, you follow people that have models, right? Anybody who has a model cannot be a perma anything. But generally speaking, if you had to pick between the good and the dark, all American bears have failed since 1790 for a reason. That's my tagline. And it'll be this until the day I die.
And it's going to be on your gravestone. You've already said that. So, now we know. That's pertinent for Halloween. Okay, so we have a lot to talk about today. We are going to get to rates, of course, because it has been crazy volatile on the 10-year yield. But first, we wanted to talk about home sales and what we saw today and how that relates to our tracker.
Yeah, so one of the things that we try to highlight is that our data is a lot forward-looking than most of the monthly reports. So by the time you get the monthly reports, it's it's going to shock people that all of a sudden pending home sales is not only beat estimates, but showing positive year-over-year growth. So what we do with our tracker article, we take the 10-year yield and where purchase application data works with, and then that looks out 30 to 90 days. And then our weekly pending contracts are those that go into signing right away. So that's going to be maybe a month or two before it actually hits the sales data. The pending contracts for some time have been getting better. The purchase application data before rates actually started to rise, it was the best 18 weeks of the year. Nobody talked about it, literally, just because I think this goes into the lack of experience. A lot of people see that the volumes are down and they don't know how to talk about supply and demand equilibrium with a kind of a flat sales trend. So they immediately try to convince people that sales are going to crash even more. And it's just experience. They don't have it, right? These aren't housing analysts or data. These are just doom porn people. So what occurred is during that time frame, while everybody ignored it, the data got better and it's finally filtrated itself into finally you get these monthly prints that catches up to our pending contracts data. And now it's so evident that this morning we're just showing it to everybody. Hey, listen, this was happening 6-7 weeks ago. Nobody cared. And so some people were shocked because they thought, we had taken another big dive on pending home sales, and it's just not the case. We go to the ground roots of one of the staples of my economic work for the last 14 years is that it's really rare in America to go below 4 million monthly sales. We didn't have total existing home sales go under 4 million last year. And now with the pending contracts and everything picking up, we have a shot to even go a little bit higher than what we did last year. So mortgage rates going up is going to impact the demand. Now, this morning, purchase application data, positive 5% week to week, positive 10% year over year. Again, the low bar theory of October, right? October is going to have really historical low bar. So take the year over year growth in context. But when you're working from such low levels, I encourage everyone, when you read our tracker, go look at our purchase application data chart. Even when rates were in the sevens, you don't see the big volume declines anymore like you did, a few years ago. So we're just working from a very low base of sales. And I think that's supply and demand equilibrium. Unless you're trained and tracked to read housing data and economic data, you're probably lost. And I think the confusion today was that they see this big rebound and then this year over year growth. And listen, the tracker would guide you all the way to it. So I encourage everyone every weekend, go look at our tracker. It is the most prolific, fast forward way to look at housing data ahead of everyone else. Don't wait for the existing home sales or the pending home sales. Also, don't wait for the Case-Shiller index, right? Case-Shiller index came out. Home prices up year over year. By the way, Sarah, I did not get one person, one brave American, Chinese, Russian, or Iranian person on planet Earth to give me their 2024 price forecast that were housing crash people. I goes, give it to Halloween. I said, I'll give you to Halloween to do it. Nothing, zero. One of the things that Mike and myself have found interesting is that when rates were going lower, the pricing firmed up. It also firmed up in a seasonal weak period. You don't usually see this. In 2022, home prices were authentically declining outside of the traditional seasonal declines you see in prices. It's the exact opposite in this case. The shock and awe, I think, like Twitter X is the devil's den. It's just pit of hell. It has gotten so quiet there for me that I go, is anybody around? Anyone? I used to get like 100 people, how's prices going to crash? And I mean, now it's, you never had it in you. You were never housing people. You're
Okay,
good doom porn people, but you were
let me ask you
never a
this.
housing person.
So, why were you and Mike, so we're talking about Mike Simonson. He's the president of Altos Research, which is the data that you're using, which is that fresh every weekly data on all of these, property selling points, all those things. So were you guys surprised, and what is the explanation?
When you get such a very low level of sales base, any kind of growth in the forward-looking data can firm up pricing. Now, because rates are still elevated, I thought, the whole thing about me was, I forecast 2.33% nominal home price growth nationwide because I don't think if rates could get below 5.75%, my complete housing market dynamics changes, right? But I just can't forecast that, so I can't go into that. But the fact now that we've had twice now, since November 9th, 2022, people, the whole housing dynamic shifted after that. Getting rates towards 6% creates a positive forward demand curve, and it actually impacts the pricing in a seasonal weak period. See, in a seasonal strong period, that's fine. That's normal. I wouldn't be, but during the seasonal weak period, it actually firmed up. Now, rates being elevated, can that change it? It's pretty late in the year. People are going to start withdrawing their listings and, inventory, but that is now twice in this chaotic period of times that the forward-looking data gets better when rates head towards 6%. So everyone should kind of be mindful of that, because if it does occur again, and you're listening to the price, remember the whole thing was that lower rates were going to bring millions of homes to the market, and home prices are going to crash because of that. And it doesn't matter what it is; they always have something, right? That wasn't the case, and I think that I've done this for 14 years. The absolute silence from the housing price crash people, in terms of talking to me, like they still do their garbage every single day, but in terms of actually that's how shocking this data line is, that even they are like, whoa, we did not anticipate that, because they saw inventory growing and they just don't have, one of the things we've highlighted recently is that there's been periods of times and decades that we have rising inventory, rising sales, and rising prices. A lot of people don't know that. They don't track the data. But here in this case, you had rising inventory and just stable demand. Nothing big, nothing growing, nothing crashing, just stable demand. And it just firmed up the pricing. Why? Because the total active inventory data is still low, right? There's just, again, kind of the theory, there's still too many people chasing too few homes. You don't have sales crashing. That's how this equilibrium works. And this is why we always highlight everything changed after November 9th, 2022. We still have people today, 2 years later, who don't understand what's going on here. They keep on thinking home prices have to fall 10, 15, 20%. No, it's not the case. And this is why we believe in people who have models and data and tracking and can back test it and show it. And now all of you get to see it ahead of all the sales reports and price reports that are monthly and a little bit stale.
I think one of the charts that you put up often that is so interesting is that home prices rarely go down. In our history since, I think you say 1942, 1947, something like that, there's been only, of course we had the prices after the great financial crisis, and then like one other year. Otherwise, home prices just tend to go up. That's the way it looks.
Yeah, since 1942, if I take 2007 and 11 out of the equation, again, a lot of forced credit sellers, new listings data. Our new listings data is always the key to this. Back then, it was running at 250 to 400,000 per week. The last 5 years, 30 to 90,000. You don't see sellers getting in there and creating the volume of competition of people selling down with prices. And now this is such a historical period of time because 2023 and 2024 were the two lowest sale levels ever if you adjust it to the workforce. And a lot of people said prices follow volume, so home prices have to fall. People just make up numbers. Sarah, what do we love? We always love the 10, 15, 20% people. These 10, 15, 20. Do you have a tracking model? No, there we go. Just throw it up there. Hope it sticks, right? So, and here it is. This is like a historic period of time. And the only thing that we could reference this to is the early 1980s, where the early 1980s had a huge sales crash. There was a lot more inventory back then. We had a recession. Mortgage rates were double digits and home prices didn't fall, right? It's the supply and demand equilibrium. And again, it's very difficult if you don't have any models or you track live weekly data. Like, how would you know? And you have just a lot of people guessing. By the way, for all of you that sent me that TikTok guy last night. Well, guys, look at me. Do you think I would even want to even watch? I watched 8 seconds of that and I knew it was trash. Listen,
Okay, well, first of all, you're saying, look at me, and this is, most people are listening to this, they're not watching.
Yeah, but I mean, I'm just saying. People send me these videos of these things. Like, TikTok is trash. Instagram is trash. Facebook is trash. Twitter is the pit of hell trash, right? So how do you deal when you go into the devil's den? You send something worse than the devil. You send the hellhound Wolverine in, and you take them all out, right?
And that's huh?
I embrace the fact that you people send me this stuff, but it is unless somebody tells me, by the way, these are my forecasts for the last 5 years. By the way, you ask men for their forecast. I don't do that. You want me to write my name in forecast? No. You get their forecast, and if they can't give it to you for the last 5 years, they're cowards and frauds. Don't waste your time on TikTok. Geez, TikTok's the worst. But we create models so you all could think about how much we try to educate the society and educate it. What do fanatics hate in the history of human civilization? People reading and being smarter and not falling for the Mickey Mouse acts, right? That's why teaching people economics is such a beautiful, I love it. I love it. I love it. When I die, they're going to say this guy actually tried to teach people this stuff. And that's the way you want to go.
Okay, so we've talked about home sales. We've talked about home prices. We got to talk about what's going on with the 10-year yield. We knew this was going to be a crazy week with the different jobs data coming out. We had ADP, so we're talking about this on Wednesday. Had ADP come out. What is going on with rates? Okay,
so I've had hundreds of people now send me things about Trump and higher mortgage rates and everything. And again, I think the hardest thing for me as a 10-year yield guy is that the 10-year yield is really economic data and then how bond market people look at money flows, right? And, we created the Gandalf and Hodor lines. And I think maybe the easier way for me to explain it, people that control the money that goes into bonds, it's not as appealing to them to put more money into the bond market if the economic data wasn't getting weaker at the Gandalf line, at the Hodor line. So kind of maybe think about it in that way. And then 2024 was very similar to 2023, right? Gandalf held, yield shot right back up, mortgage rates went to 7%. Hodor broke a little bit, hovered, and then the economic data was getting better and it shot up and mortgage rates went back to kind of 7%. So ebbs and flows, right? This is why the forecast is 5.75, 7.25, ebbs and flows. It's just the same thing in the last decade when I started to do this. I just had the 10-year yield in a range between 1.6 and 3%, right? 3.25, 4.7, back and forth, back and forth. You have to find these ranges and where people think, Fed policy, economic data, where it's going. Now, if the economy was growing at 1% and jobs data was really weak, 10-year yield can go lower. But today, this is Wednesday morning, the ADP report came in, beat estimates by a lot. GDP growth came near 3%. The consumption data of the GDP data was really strong. So the 10-year yield went up a few basis points, came down, went up. It's back and forth. But for now, for just Jobs Friday, two levels. We don't want the 10-year yield to break above 4.34. And we really do not want the 10-year yield to break over 440, because the 440 is that downtrend from 5%, and the 4.34 held this week. So people, I think, were anticipating bond yields to go a little bit higher, mortgage rates to go a little bit. Nothing is happening as of this day. This is Wednesday morning. Tomorrow's jobless claims, things could be different. But it's pretty wild action right now. So when you get this frantic action near key levels, and then you ask yourself, do bond traders really want to short the 10-year yield here? If something gets weaker, they probably wouldn't. But we'll have Jobs Friday to take a look at it. Not a lot of people value the ADP reports, but job openings came in softer than anticipated. It's the internals are weak. Internals have been getting softer for 12 months now. But the key for Jobs Friday is, where's the wage growth data? If it's 140 to 165,000, that's the Fed's probably extremely happy with that at this point. Anything above that to me is a beat. But if wage growth is slowing down, you get sub 100,000, the 10-year yield will look at that and say, hey, listen, the internals of this are getting weaker. So you can maybe go down a little bit lower in yields for them. But pretty frantic action. I understand if you're not a nerd like me, it's confusing as what's going on with rates. But this is why Gandalf was created last year. This is why Hodor was created this year. And just think of like a bond trader or a bond, somebody who tons of money, bond mutual funds, a quant, they just do these technical levels. And those that follow us on Instagram, on my page, you can see all I do is 10-year yield, this is happening. And so crazy mad scientist, but this right. is kind of how it kind of works. And it's not the most understandable subject. But we try to do our best to talk about key inflection points. That's why Gandalf was created last year. That's why Hodor was created. And again, if the GDP was running sub 1% and jobs data was missing, we're all having nobody's talking about the elections or anything. The economic data ran this, and look what happened. GDP near 3%, consumption data fine, so that makes sense why bond yields should have gone up if the labor data isn't breaking.
So I know that these are all different reports, but I know that, the Fed, their favorite report is on Friday, right? That Jobs Friday report. Do the ADP numbers, do what we've seen already, give us any indication of what that report's going to say? Like, do they give you an indication of where we're going?
I don't put any value on the ADP report, and not a lot of people do anyway.
But does it show you like where a trend is that we?
Well, that's the thing is that sometimes the ADP report comes in really low, and the Jobs Friday beats really big. So that's why there's not enough consistency in the ADP report. But the job openings data, the internals of the job openings data was soft.
For those of you watching the podcast, not just listening, we had a little technical difficulty, so Logan has relocated. That's why it looks different. So Logan, close us out here. What are your final thoughts on this jobs week?
So when jobs reports comes out tomorrow, let's see how the bond market reacts to whatever the data is. It's been very volatile this week. Just realize that economic growth was stable at 3%. That's above trend, what the Fed wanted. The labor data has stabilized. It's getting softer from its, hot labor market. But see how the bond market reacts initially and how it does throughout the day. It's been very wild on the day-to-day stuff, so it's hard to interpret anything. And just keep a key level, 3.34, 3.40. We want to stay away from that area. And if it does break, it could cause a little bit more chaos. But for now, I think the last time I saw, we were at kind of 4.24%. Again, let's see how Friday closes. And soon we're going to have a lot of events out of the way, and we could just focus on the macroeconomic data on a day-to-day basis.
I would also remind our listeners, Logan provides a daily update on where he thinks pricing is going every day on our Mortgage Rate Center page. So you can look at that. And also next week, which is election week, we'll have election day, but not really confident that we'll know exactly who the winner is. Amid all that volatility, I'm going to have Logan on 3 times next week to walk us through what's happening with rates in the middle of that. So check out the tracker and our mortgage rates page, and stay tuned for more Logan next week.